For many Canadians, the topic of capital gains taxation has been a source of significant confusion over the past year. Proposals floated in 2024 suggested a major shift was on the horizon, one that would have increased the portion of capital gains subject to tax. This potential change, which would have lifted the inclusion rate from 50% to 66.7% for gains above a certain threshold, caused considerable uncertainty for investors, small business owners, and families planning their financial futures. Many were left wondering how to plan for the sale of a cottage, a rental property, or their investment portfolio, with the rules appearing to be in a state of flux. Thankfully, clarity has been restored. In a decisive move in March 2025, the federal government officially announced that the proposed increase to the capital gains inclusion rate was canceled. This means the long-standing rule remains firmly in place. The inclusion rate for capital gains in Canada is currently 50%. This applies to all individuals, corporations, and trusts, with no new higher rate threshold to worry about. The decision provides a stable and predictable environment for long-term financial planning, reaffirming the existing framework that has governed Canadian tax law for years and ending a period of speculative anxiety for many taxpayers. So, what does a 50% inclusion rate actually mean for you? In the simplest terms, it means that only half of the profit you make from selling a capital asset is added to your income for tax purposes. For example, if you sell shares and realize a capital gain of $20,000, only half of that amount, or $10,000, is considered taxable income. This $10,000 is then added to your other sources of income for the year, such as your salary or pension, and taxed at your personal marginal tax rate. This preferential treatment is designed to encourage investment and risk-taking in the economy. This stability is crucial for anyone holding capital assets. Whether you are an entrepreneur who has spent decades building a business, an investor carefully growing a nest egg for retirement, or a family that owns a cherished vacation property, understanding this core principle is the first step in managing your tax liability. The consistent 50% rate allows for more effective planning, as you can calculate the potential tax impact of a future sale with a much greater degree of certainty. It removes the guesswork that clouded financial decisions during the period of proposed changes, allowing Canadians to move forward with confidence.
Understanding how a capital gain is calculated is fundamental to grasping its tax implications. The gain is not simply the price you sell an asset for, it is the profit. The formula is straightforward. The proceeds of disposition, which is just the sale price, minus the asset's adjusted cost base, or ACB, and any outlays and expenses incurred to sell it. The ACB is typically the original price you paid for the asset, but it can also include subsequent costs, such as commissions on a stock purchase or the cost of significant capital improvements made to a property. Keeping meticulous records of these costs is therefore essential to ensure you are not overstating your gain and consequently overpaying your tax. Let's apply this to a common scenario involving investments. Imagine you purchased 100 shares of a company for $50 per share for a total initial investment of $5,000. This is your initial cost base. A few years later, you sell all 100 shares for $90 each, receiving $9,000. Let's say your brokerage charged a $50 commission on the sale. Your capital gain would be calculated as the sale price, $9,000, minus the original cost, $5,000, and the selling expenses, $50, resulting in a capital gain of $3,950. With the 50% inclusion rate, only $1,975 of that gain would be added to your taxable income for the year. The same principle extends to real estate, such as a rental property or a family cottage. Suppose you bought a cottage 10 years ago for $200,000. Over the years, you spent $50,000 on a major capital improvement, like adding a new foundation, bringing your adjusted cost base to $250,000. Today, you sell the cottage for $480,000 and incur $20,000 in real estate commissions and legal fees. Your capital gain would be $480,000 minus your ACB of $250,000 and selling costs of $20,000 for a total gain of $210,000. Half of this, or $105,000, would be taxable. This example highlights the importance of tracking capital improvements. It is crucial to differentiate between capital expenses, which increase your ACB, and current expenses, which are deducted annually against rental income. For a rental property, replacing a roof is a capital expense that adds to the ACB, while repainting a room is a current expense. For a cottage, only capital improvements can be added to the cost base to reduce the future capital gain. Failing to track these capital costs means you will pay more tax than necessary when you eventually sell the property. Good record keeping is not just good practice, it is a powerful tax-saving tool that can save you thousands of dollars down the road. The Canadian tax system includes some incredibly valuable exemptions that can eliminate or significantly reduce your capital gains tax bill. The most well-known and widely used of these is the Principal Residence Exemption, or PRE. This powerful rule allows you to sell your main home without paying any capital gains tax on the profit, no matter how large it is. For this exemption to apply, the property must be designated as your principal residence for every year you owned it. A family unit, which includes you, your spouse or common law partner, and your children under 18, can only designate one property as their principal residence for any given year. To illustrate the power of the PRE, consider a family that bought their home in a major city for $400,000 2 decades ago. Today, they sell it for $1.5 million, realizing a capital gain of $1.1 million. As long as this home was their principal residence for all 20 years they owned it, the entire $1.1 million gain is completely tax-free. This exemption is a cornerstone of wealth creation for many Canadian homeowners, allowing them to build equity without the erosion of taxation. It is important to note, however, that if a portion of your home was used to earn income, such as a rented-out basement suite, a part of the gain may become taxable unless specific rules are met. Beyond the family home, another major tax shelter exists for specific entrepreneurs and property owners, the Lifetime Capital Gains Exemption, or LCGE. This exemption was recently increased and now stands at a generous $1.25 million. Qualified small business corporation shares, qualified farm property, or qualified fishing property. This is a lifetime limit, meaning you can use it across multiple sales until the total exempted gains reach the $1.25 million ceiling. It is designed to reward the risk and hard work associated with building a small business or running a primary industry operation. For example, an entrepreneur who started a successful tech company from the ground up could sell their shares in the business and shelter the first $1.25 million of capital gains from any tax. If they realized a gain of $2 million from the sale, the LCGE would eliminate tax on the first $1.25 million. Only the remaining $750,000 gain would be subject to the 50% inclusion rate, resulting in $375,000 being added to their taxable income. This exemption is a critical component of succession planning for many business owners and farmers, facilitating the transfer of assets to the next generation or providing a tax-efficient retirement fund. Beyond the major exemptions, there are several effective strategies you can employ to legally minimize the amount of capital gains tax you pay. One popular strategy is tax loss harvesting. This involves selling investments that have decreased in value to realize a capital loss. This capital loss can then be used to offset any capital gains you have realized in the same year. If your capital losses exceed your capital gains in a given year, the net capital loss can be carried back to offset gains in any of the 3 preceding years, or it can be carried forward indefinitely to be used against future capital gains. Timing the sale of your assets is another crucial strategy. If you are planning to sell an asset that will trigger a large capital gain, it might be beneficial to defer the sale to a year when your overall income is lower, such as after you retire. Since the taxable portion of the gain is added to your income, a lower income year means the gain will be taxed at a lower marginal rate. If the sale is particularly large, you could also consider structuring the transaction so that the proceeds are received over several years, spreading the capital gain across multiple tax periods and preventing a single-year spike into a higher tax bracket. Gifting assets and thoughtful estate planning can also be powerful tools. while gifting an asset to a family member, such as a child or grandchild, typically triggers a deemed disposition at fair market value for the person giving the gift. It can be a strategic move. For instance, you could gift investments to an adult child in a much lower tax bracket. Future growth and income from those assets would then be taxed in their hands at their lower rate. Trusts can also be used in estate planning to split income and capital gains among multiple beneficiaries, potentially reducing the overall tax burden on your estate. Finally, never underestimate the simple power of good record keeping, especially when it comes to claiming capital improvements on properties like cottages or rental units. As mentioned earlier, every dollar spent on a capital improvement, from a new roof to a finished basement, increases your property's adjusted cost base. This directly reduces the size of your eventual capital gain. Always keep detailed receipts and records of this work. Ultimately, a combination of these strategies, tailored to your specific financial situation and ideally discussed with a professional tax advisor, can ensure you are not paying $1 more in tax than you absolutely have to.